Good morning, ladies and gentlemen. After a bloody month in the market, it could possibly be getting bloodier in the future. Today, we're going to be giving you our midweek update, like always. So without further ado, let's get into the video. The S&P 500 on Tuesday, February 28th, the last day of the month, closed down red at 0.37%. The NASDAQ closing almost flat at negative 0.13%. And the Dow Jones closed down negative 0.76%. So Dow, the worst performer of the day, S&P in the middle, and NASDAQ leading the pack with the strength. As tech has been leading this rally, it also showing strength still. So today we're going to be talking about quick refresh on the levels, and we're actually going to be going over some larger time frame graphs today, which is very, very important. I preach this all the time. Look at the larger time frames to understand what's happening. So if we look at the daily here, we have our Monday candle, which we basically consolidated in the kangaroo between the 50 weekly and the 200 daily. Now we have broken our 200 daily after failing to retake our 50 weekly for the second time in a row. We tested yesterday, broke above it, bears came in, slammed it back down. Today, you barely broke above it, and then all you did is found sellers and faded the gap the whole day long. You finally filled the completion of this gap here, which you failed to do on the previous day. Closed at the low of the candle, forming a inverted hammer or a hanging man candle. That is a very bearish sign. This consolidation right here has me a little concerned because it's reminiscent for the bulls out there and the bears at the same time. You have this reminiscence of this consolidation back here, which we basically then rallied up further. I don't believe that we're going to get a rally. Full disclosure, I'm more bearish skewed, and I openly talk about this on the channel that I'm bearish skewed in the market. I am selling call spreads in order for them to expire out of the money. Soon we're going to have a video on that, so stay tuned for that. Now, so what are the key levels that we talked about in the weekend deep dive? Link down in the description below, guys, if you haven't taken a look at it. Great long debate, long form of what were the critical levels. 400, obviously, that was your weekly 50 SMA that you needed to basically break above and hold. That was our first key level of support that we needed to claim. Second, 404, which was the previous week's high. I don't believe we're getting up there personally, but the week is still young. We still have today, tomorrow, and Friday. What happened on Tuesday? You broke below your 200 daily. Now, where does that give you? At the time of recording this video, which is Tuesday afternoon, the futures are trading at nearly 0.5% down. The S&P is down about 0.42%. So that literally does not put you at the base of this candle right here, 395 roughly for the S&P. And then we hop over to NASDAQ real quick. It's right in the middle of this gap area of 292-ish. Let's say to all the way down to 291.5 for the gap fill. So for the S&P, where do I see us going? Since we need to really look at longer term timeframes to answer that question. I always preach about going to larger timeframes because it gives you a clearer picture. Now we're going to take a look at the monthly. The monthly is a hanging man hammer style candle. This is very bearish. You have a significant wick on the candle that is almost over 60% of the length of the body. You're trying to test your long-term uptrend here on the monthly, possibly breaking it. We got to see on the daily, but really it's a very bearish sign. You fail to have a breakout if we look at the Dow Jones. So you're breaking down. Bullish, you're breaking down. Bearish engulfing candle. So this is very bearish. This is telling you that you have subsumed all the price pressure before and you're heading lower. The Dow is finally below its 50 weekly EMA. So this is the industrial sector. If we look at the Russell, which is 2,000 companies, this is something you have to pay attention to because it will give you a broader breadth of the market, because the S&P is 500 companies, the Russell's 2,000. So you have a spinning top hanging man candle, failed breakout right here. So now where could we possibly be going? Lower. The Russell is the only index that has not failed to lose its 50 weekly EMA. So once the Russell cracks 184.32, which is about $4 for a percentage basis, let's see, that's about 2%. If the Russell cracks 2% lower, you will lose a 50 weekly EMA, and then it is significantly more downside than we're probably going to see, and tech most likely will lead that downside. If we look at QQQ, it is as clear as day a gravestone doji. Bad things happen when you have a gravestone doji, guys. There is significant selling pressure here, and we want to then see for the next month going forward, continuation from the bears to keep pushing us lower and lower. We should see probably, I'm saying, at least half this candle from the previous month be taken out. That will put us down at 280, around the 50 daily moving average and the 200 weekly moving average. Once NASDAQ loses 282.47, it's basically lights out for the market, because that is going to send you basically into what I would believe is almost a death spiral. We're just going to keep making lower lows and lower highs. There's going to be no mercy there, because the market truly hasn't repriced interest rates in my eyes. We're seeing them warming up to the idea of the higher for longer narrative. But to me, the true test or the true indicator of when we get to a true bottom is when the fear and greed index hits 25. So just quickly pulling up the fear and greed index. Our previous close was 61, now we're 59. We're slowly chipping away at this number, but we're not even neutral. We're not in fear. Like the last time we had this mass push back down to fear, we had a pretty massive 8% sell-off. So you really haven't explored different parts of this indicator where it's actually in fear. You're still in greed, neutral, extreme greed, and then neutral for macro momentum. So it really is a indication that we have a lot more downside possibly, but we need to see where we would find support on the S&P to give us targets for that downside. So going back to the daily real quick, you have the next test, in my opinion, is 393.73. You lose 393 basically, or print 393.13 or lower, which is your 200-day moving average. Basically on S&P, it's just going to play itself out. You print a lower low, 393. On there, you're basically lights out for the market. You're heading lower. You're probably going to be exploring back down to 380, 390, and then probably the 381 to 375 region, back to this consolidation period here. I do think that once we crack this level here, you would have a leg down to the 388 level, to where you would probably find some consolidation and a leg down. Or honestly, because no one has to have a bounce, we could have something like this: come down, bounce, go down lower, back going to our August low. So it really is dependent on what we do. Simple levels: crack 393, 200 daily moving average, retest, more bearish downside. If you get above the 50, then we can be looking at exploration to the upside, getting above 400. And really, to me, it's going to be getting back above this gap fill at 409. That will be our levels. We want to start taking out these gaps up here and then advancing the chart. However, we will cover that if we get back up there. I don't believe so. Every single day, what I've been witnessing is, if we look on the intraday chart, on the close, you're seeing big red volume coming in. Today, on the close, which mattered for the monthly close, the bears came in the last hour and just sold you off all day. They waited to the end. The bears are getting a free meal from the bulls. They waited to the end. They waited for the bulls to swim upriver. They're the fish swimming upriver for the bear to get a free meal. They let them push the market up and then basically let sellers exhaust, creating walls, and then they basically flushed it right down. That's what you want to see. You want to see the conviction from the bears. What do you want to see from the bulls? You want to basically see that you're going to have more momentum to the upside. So really, we got to see bulls fix this chart. You're below the 200. You're now in no man's land after post market, and you're probably heading back to this 393 retest and heading lower. So now let's take a look at some of the other catalysts that we follow for follow through. What is the dollar saying? Looking at the dollar on the daily chart, we're breaking out and we're actually advancing. We had a bearish engulfing candle on the previous day, followed by today with a bullish partial engulfing candle, and now we have a gap up trying to possibly tackle this 105.5 region, which would be our 50 weekly moving average. If dollar creams basically 106 is where I'm thinking, in this region up here, and starts advancing, we're definitely going to have a very nasty downside to the market. The dollar and the market are inverse to one another. The dollar is strengthening, and also let's take a look at the VIX, the fear and greed index. So the VIX came back down to its long-term trend line and has really been forming almost a push up, come back down, retest this trend line, confirming, and we could get a push higher. Also, the VIX, if we look on a long-term time frame. So if we look at VIX on the long-term time frame, we see possibly a W forming here, where now we want to see that expansion upwards. If VIX confirms this W by, to me, trading above the $23 region, which is where we need to see VIX kind of like start to power up and conquering these $23, $25 levels, is definitely where I want to see VIX going. All right, we broke out this descending wedge here. So price target for it is, after we break out here, is up in this $28 region, which would be a massive drop on the market. VIX basically powering up. And remember, because of 0DT option, VIX's massive move is going to come out of nowhere. You're not going to get the warning signs because the run to the VIX is going to be when everything starts to break. Everyone is already seeing the consequences of the actions that are causing the market to go down, because the 0DT options are not going to support enough as a hedge to where everyone needs to now go to the VIX to hedge their portfolios. So remember, VIX is not going to act like it acted back in 2019, where you could have predicted almost every single rip on the market and every drop on the market because the VIX would always predate it. So you really have to pay attention to VIX when it starts hitting these key levels and giving a warning sign in the back of your head that, hey, I need to be paying attention to this because this is holding a trend. If it's holding a trend, then you gotta be cautious in the market, or you can be short side, because the risk to reward, in my opinion, is skewed to the short side, because you can be a little earlier and make more money, or you can get stopped out for a small loss, but you're in there for a nice profit. Next, let's really take a quick glance at the yields. So my favorite, the 1 year. I've been talking about this till I'm blue in the face, guys. The 1 year is still flagging out, and based on this daily chart, it looks like it wants to power up. It wants to rip everyone's face off. It's powering up. We could get a nice push up tomorrow or today, possibly. Based on this early data from the candle, we're at 5.04. Once we cross 5.06, which is not far for this, you're going to be powering up. Let's take a look at the 2 year. 2 year, chugging up along, powering up. 5 year, same story, maybe losing a little bit of steam. 10 year, consolidated, probably going to push up higher. 30 year, flagging out possibly, forming a pendant. TLT, which is your bond market, had a nice green day today. However, at post-market sold off, so we got to see what it's doing on open today. But just looking at the short-term risk to reward, people are flooding into treasuries because this risk to reward is very advantageous. You had this big push up consolidation, and you could be getting your big push up now. You're flagging out on the daily for the 1 year yield, and this would basically put the 1 year, if we draw this out, flagging out, targeting 5.295%, which for 1 year yield has never been this high in existence. This was the .com bubble over here. So the .com was 2.6%. We're at 5.0. The 2019 big crash that we had, that was like a mini Fed tightening crash, you were at 2.6. You double topped all the 2008 top. You are so far from that it's not even funny. So we have to pay attention to yields. We have to pay attention to the VIX. We have to pay attention to the dollar. They're all screaming that the market is going down. There's more downside opportunity than upside opportunity. So we have to be receptive to that and position accordingly. So now the question is, what do I see for the future for the market? I think once the market truly reprices the bond, truly reprices the Fed is going past 5.25%, because that's what the 2 year is indicating. The 2 year is actually what the Fed chases. And you guys know this graph. I've showed this graph so many times, I'm blue in the face. 2 year just made new all-time highs, and we're heading higher at 4.839%. What does that reminisce you of? Oh, 5%. What happens when the Federal Reserve raises rates? This thing goes up. So 5% rate, right before the FOMC meeting, is going to go to 5.5. Once it goes to 5.5, then 6. So all this is telling me is that the Federal Reserve has to chase this thing like no tomorrow. And they're at 4.3. Why do you think 4.8? Because now we're pricing in a 50 basis point jump on the next meeting. Once that happens, the 2 years probably going to push up higher. We really have to see. And we're going to get the summary of economic projections on March 22nd from the FOMC meeting, where we're going to see the terminal rate projection. If that gets revised to 5.5, 7.5, God forbid 6, the market's going to lose itself. So right now, like everyone's saying, oh, the market's down, maybe not a bad time to get out. If we look at what Luxalgo is telling us for the market, the S&P, you are curling on the MACD. Oscillation has basically given you an indication that it could be possibly bottoming, but I don't believe that because we've broken our trend. We're down at post-market. If we look at ES, which is the futures, I've seen this trade happen so many times. We converge and diverge on the MACD, RSI heading lower. Oscillation hasn't bottomed on the futures, so we're probably heading lower, targeting, like I said, starting at 390 for the futures, which would put the S&P 388 roughly, all the way down to 375 to where we were previously. There's a slight offset on futures versus S&P, but overall, this is telling you more downside. S&P showing bearishness. QQQ, diverge, MACD split across one another, bearish. Dow Jones, Dow broke this pennant down, so now we're probably coming back down to this level of 380. We're probably coming back down to 318 on the Dow Jones. So definitely something to be on the lookout for as possible buying opportunities, but I would definitely be looking more short side. So if you guys enjoyed this type of video, throw down in the comment section what you like. If you don't mind, hit the like button. It really helps the YouTube algorithm, and subscribe for more content that's going to be coming out in the future. We're going to be doing more teaching videos coming up, so definitely something that to look forward to. And with that, I will see you in the next video.